What is up, YouTube? I'm Adam Odell, Chief Investment Strategist at moneyandmarkets.com, and I'm joined by my research analyst, Matt Clark. And we're here for another episode of Ask Adam Anything, where you can leave us a question in the comments section down below. You can email us a question. We get emails from our subscribers routinely because we encourage that communication two ways. So once a week, I'll go through and Matt will find the most important question of the week, and we'll try to dive into that. So Matt, it's been kind of a shaky start to the year as far as stock prices go. So I think that you mentioned that you have something in that regard. So why don't you go ahead and tee up the question and we'll go from there.
I do, thank you, and yeah, since the beginning of the year, even kind of a little bit towards the end of December, that kind of last week of December, if you're one of those people that likes to watch your portfolio screen every 20 minutes, if you haven't had a heart attack by now, then it's probably good to quit while you're ahead, because everything is just moving in flux. It's up, it's down. The NASDAQ is down, the S&P is up. It's just kind of all over the place. But the bottom line is that for the better part of January, all three major indices, the S&P, the Dow, and the NASDAQ, are trending down. And traditional traders may kind of really scoff at that and wonder, what am I going to do? What am I going to do? However, if you're not familiar, there is actually a way where you can find profit when the market is turning towards the negative. And what I mean by this is a little complicated, which is why we have Adam here. And that is to look at what's called a put option. Now, I'll just kick things off very easily, Adam. Simplistically, for a newbie, for someone who doesn't know anything about it, what is a put option?
Yeah, so a put option, there are two types of option contracts, and they basically play two different sides of the market. Call options are options that you would purchase if you believe the price of an underlying stock or ETF is going to go higher. So if you're bullish on something, you would buy a call option. Put options are the mirror opposite of that. If you think prices are going to fall, you would buy a put option. And if prices do fall, then the value of that put option should go higher, and you should make money on that trade. So that's really why put options are bought. Typically, the most common purchase of put options is for the sake of protection. And so let's say you have a long stock portfolio, you're long equity beta, and you're worried about a correction or a bear market or some type of negative price shock, and you would buy put options to protect either part or all of your portfolio from that type of drop.
Now, there's a lot of components when it comes to options. And this is where some people get a little turned off by doing options, because it seems very, very complicated, because there's a lot of things you have to understand and you have to kind of be able to read and see what they mean. But really, at the end of the day, it's not that complicated. So let's walk through a traditional put option and walk through the components of a put option and what everything means. So you've got, let's talk about the strike price. Let's go into that first. The strike price is, for the benefit of those who don't know.
Yeah, so the strike price is the price at which you agree to buy or sell the stock if that option is exercised. Now, I've run an options trading service for 10 years now, Home Run Profits, and we've never exercised an option. We are basically trading these options. So we intend to buy them. We're always buying options, okay, which is a risk-limited strategy. You can never lose more than the amount that you've chosen to invest in that option. So that's one key point. The second key point is that basically we are always trading out of those options. So we buy them, and at some point we would sell them. We're not actually trying to own or sell shares of the stock. But to your point, what's the strike price? I mean, the important thing that you want to consider when you're buying an option, whether it's a call or a put, is how much money do you want to invest in that option? Is it $500 that because that amount of money is an amount of money that you should be willing to lose. When you buy an option, whether it's a call or a put, if the market goes against you, like let's say you buy a call option and the market tanks lower, you could lose the full value of that option premium that you bought. So I always recommend that to use, only invest an amount of money that you're willing to lose, and use that to help determine which strike you should buy. So, if you decide that you want to invest $500 in an option, you might be looking at a different opportunity set of options than if you were willing to invest $5,000 or $10,000 into an option. So it really depends on your own personal risk preference and the size of your portfolio. But, since you mentioned that question, I did actually recommend a bearish trade in my Home Run Profits strategy this week. I saw an opportunity for us to make some money on some declining prices in one particular market. And so I recommended buying a put option that was out of the money. Now, what that basically means is that the price of the underlying stock or ETF, it has to move a good distance before your option contract will actually go in the money. And typically the one reason that you would buy, there's mainly two reasons you would buy an out of the money option. One reason is that they are cheaper. So if you're buying something that's out of the money, generally that's going to be a lower priced option contract than if you're buying something that's at the money or in the money. So for folks who only want to risk a small amount of money, then that's a good way to do it. The other reason that you would buy an out of the money option is that you get more leverage with that. Okay, so options give you leverage on the underlying price move, and an out of the money option will give you higher amounts of leverage than an at the money or in the money option. So that's specifically why I recommended an out of the money put option for this trade. Basically, I wanted to be cheap enough that folks could participate in the trade and not risk a lot of money in case the market kept going higher. And likewise, I wanted a lot of leverage, or what we call convexity, meaning that if the market was to take a leg down, 10% or so, we would be making a lot more money on that trade than if we bought at the money.
And that leads me into a question that may be a little more complicated, if it's even possible to answer. You talk about out of the money, at the money, and in the money. First, let's kind of give a basic overview of what that means. And then second, to kind of follow up onto that, is there a higher reward with at the money as opposed to out of the money? How does that work as well? And again, I don't want to, you don't have to give a dissertation, but I just kind of want a brief overview of what those in the money things mean, and
Sure.
Is there a higher reward with one over the other?
Sure. So let's use very simple round numbers, and we'll go with a call option, an upside example, because that's sometimes easier for folks to visualize. So let's say there's a stock that's trading, the shares of the stock were trading for $100 per share. Okay. So that is called the underlying. It's the underlying stock that the options are on. So that's trading at $100 per share. Now there's only one at the money option, and that's for $100. So there's a strike price. If you go to trade a call option on that underlying stock and you choose the $100 strike price, which is equal to the current price of the stock, that's called at the money. Okay. It's at the money. Anything above that price would be out of the money. So let's say that the stock is trading at $100 and you buy a call option with a strike of $110. Okay, that's considered out of the money because the stock price actually has to move from $100 to $110 before it's at the money. So that would be an out of the money option. And then likewise, if you bought a $90 strike, that would be considered in the money because the stock price is already above that. Now, I kind of touched on this, but out of the money options give you more leverage. So if you get, it's a big if, but if you get the move in the direction that you expect, like if you want to trade a stock that's at 100 and you think it's going to go to 120 and that actually happens, then an out of the money option will give you a greater return than anything else. Now, that said, the out of the money options have a lower probability of success than at or in the money options, because again, you have to have that price move happen first before you get much movement in the underlying option contract. So it's kind of a balance between the probability of having a winning trade with that contract and the amount of money that you actually win if you do have a winning trade.
And we've done a lot of different videos on options and things like that. And I would encourage anyone who maybe wanting to dip your toe in the options water, as it were, to check out Home Run Profits, which is Adam's service. You've been running that service for about a decade now, I think, maybe a little longer. We'll put a link up above so maybe you can find out some more information to learn more. And Adam does a very good job of walking you through these steps. Options, again, on the surface, they seem very complicated. It seems like it's one of those games that as a new investor or as a, maybe an investor that's just kind of dabbling, it's kind of like, well, that's maybe a little much for me. But actually, it's not as hard as you might think. And Adam does a great job of walking you through the steps, how it works, what he does, and just all the way from the start of what is an option, what are the different options, and then how do the options work. And it just walks you through very easily. Again, it's Home Run Profits. We'll put a link up there and let everyone know. Adam, that's all the questions I have. If you do have a question that you'd like Adam or myself or Green Zone Fortunes coder or Charles Sizemore to answer on any one of our YouTube video series, you can you submit that question by giving us an email. That email address is feedback@moneyandmarkets.com. We'll put that down below there, feedback@moneyandmarkets.com. Or you can comment down below here on our YouTube channel. We love feedback. We love to read it. We love to see it. Maybe you are already maybe a member of one of Adam's services and you've done well. We'd love to hear that as well. what's your experience with cannabis trading to go with our marijuana market update, anything like that. We love to hear it. You can email us or drop us a note here on YouTube. Adam, I don't have anything else for you. I'm going to let you off the hook right there. Options, getting into options, which is a great wheelhouse that you are in. Definitely encourage anyone who wants to learn more to find out more by checking out Adam's Home Run Profits service there. But Adam, that's all I have for you. And until next time, look forward to talking with you again.
Sounds great. Thanks a lot, Matt.